Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise tax information to real estate professionals looking to build their own customized playbook. As always, I'm your host, Evan Ross, Tax Director with Brown Edwards and Company, based out of our Roanoke, Virginia office location. By now, you probably had a chance to learn more about Brown Edwards, but if you're a new listener, please go check out our website at your convenience. A link to that website can be found in the description of this podcast. On the website, you'll find more information on our service lines, as well as our service providers and our other office locations throughout Virginia, West Virginia, and Tennessee. With that, I would like to introduce our guest for the month of April. We have Ryan McEntire, a partner out of our Lynchburg, Virginia office. Ryan, thanks for being here.
Thank you, Evan. Happy to be here.
I appreciate you being here. So I'd love to just hear just a quick background on you, what you do for Brown Edwards and your career path.
Yeah, so I started with Brown Edwards in 2003. So I just finished my third year as a partner. I spent the majority of my career in the tax area, ran the tax department for a number of years, co-ran it with our current tax leader, Jeff Barber, for several years, but then shifted over to running our wealth management division.
Awesome. Which will obviously that's what we're going to talk about today. Before we get into the meat of that conversation, always have a segment at the beginning. Tell me more. So we were chatting a little bit before, and I think a good topic for that would be fitness and HYROX. That's really come to storm the last couple of years. So I'd love to hear more about what got you into that and kind of your fitness journey.
So I'm 52, so I'm a little late to this party. But, I've been, the last 5 or 6 years on a great fitness journey. Started with an injury. I tore my bicep, and as I started to rehab from that, just kind of really got back into it. I was a competitive power lifter in college, and through those family years, I kind of drifted away. But now my children are growing, so I've gotten to focus back into it. And then last year, my son asked if I wanted to do a HYROX with him. So they have these team competitions at HYROX, which are a lot of fun. So last March, we did the DC HYROX together and absolutely had a blast. Kind of became addicted to it. So we've been working on scheduling our next one, but they're really hard to get into. We tried Miami, we tried Houston, tried DC, but we finally were able to land. And so we're going to Ottawa in May.
Wow, that's exciting. Yeah, it's one thing that I haven't done that yet. It's on my list to do. I don't think I realized how difficult it was to sign up. I've been on the website and looked around, learned a little bit more about it, but I've never actually gone through the registration piece. Is it similar to like a concert or ticket sales where there's like a pre-registration and like, hey, they go on sale this date, this time?
Yeah, I think my son was able to do it. He had literally 2 computers, his computer set up, his wife's computer set up, and his phone.
Oh,
And
wow.
we got in on the phone in Ottawa. But I think HYROX is starting to get this figured out. Alex Kriloff was one of our vendors on the tech side he's actually a HYROX. He's been wanting to do HYROX too, and he's in Houston, and they were booked out. But then he just told me last week they added a whole week in Houston.
Oh, wow.
So they added 5 extra days to accommodate everybody coming in.
That's great.
Because the other kind of way that people have been sneaking in is they actually have a charity day. So if you raise $5,000 for a charity, they have a day for just teams that did that.
Oh, wow. Okay.
But now that's filling up as fast as any of the others.
That's still cool though, a way to give back to charity and still get in. But it sounds like they're catching on to the demand that they're getting for these events.
They have, and it is a blast. And the demand is high because it's so much fun to go to, because it's kind of like a dance party and fitness competition all rolled into one. There's DJs. I mean, there's confetti cannons going off, and it's a real high energy atmosphere. The spectators can wind around the events, so your spectators can follow you as you go.
Oh, wow.
And then you do your kilometer in between each event on the outside. So they're just kind of turning around and then you're seeing. So it's spectator friendly. And
it's awesome that you're not locked into a seat or anything, and you can kind of see the whole event throughout. So that's awesome. So yeah, we'll have to talk more offline about
that's right.
about that, because I'd love to hear more, because that is something that's been on my list to do at some point after tax season, or maybe next fall or next year sometime. So awesome. Well, as much as people, I'm sure they'd love to hear more about HYROX and your fitness journey and all that kind of stuff. It's really interesting stuff. But let's get into the meat of the conversation today. We're going to talk about wealth. So I just love to hear from you. kind of a CPA firm, I don't think traditionally people would think wealth services. I think
That's
most people
right.
are probably going to think A&A and tax services. So kind of tell me what got you into that space and how you got to where you are now.
Yeah. So it started about 11 years ago. And it actually, the concept started at a partner meeting. And we were, tax people, and Evan, you can appreciate this. When we get it together, we tend to tell horror stories about the things that we see that happen to people. And we had one of those events and we were talking about investments. We were talking about, people being put in investments that they shouldn't have been in, talked about people whose brokers may have been overly trading in their account to generate fee, the challenges to people getting put in annuities that they didn't belong. And our managing partner at the time, looked at me and said, "Can we do something about it?" And I said, "Well, I guess we could run our own wealth firm." And he said, "Great, go do it." And so that's how it was born. And that is our philosophy that we carry today, which is do the right thing for our clients. We started this to take a CPA approach to providing investment services, which takes that same kind of integrity and client focus that we're so passionate about as CPAs, and then deliver this additional service. And so we set up as a fiduciary. We're a fiduciary level advisor, which means that we have to do what's in the client's best interest, which of course aligns with those goals that we wanted. So different from, say a broker dealer, where a broker dealer, they only have to be suitable. Their investments need to be suitable. Ours need to be in the client's best interest. So it kind of puts us on the same side of the table with our clients, right where we want to be as trusted advisors. And it just kind of fit really well with our brand.
That's great. Yeah, great to see your passion for that and how much it's grown since it was started 11 years ago. That was just before I came over to Brown Edwards from through a merger. So it's cool to kind of see where that started and where we are now. So, and there's, I'm sure, a lot to look forward to in the future.
Yeah, we currently manage about 420 million of assets, and that's pretty much all money from our existing clients. We've had an annual growth rate of somewhere between 20 and 30%.
That's great.
And,
That's great. Yeah, I'm sure a lot of these listeners probably weren't familiar that Brown
right.
Edwards had a wealth practice. That's good to get the word out a little bit. With that, let's just kind of talk about the marketplace right now. What are you
Uh-huh.
seeing currently?
Yeah, I think what we're seeing most from our clients, and the feedback is there's just lots of concern and uncertainty. And when we look at where we're at, I mean, the markets, we've just come off of all-time highs, and the last labor report's really good. I mean, all the fundamentals are solid, but there is some feel among our investors, a lot of the commentators, I would be lying if I didn't feel it myself, that feels like there's some concern and uncertainty. I think a lot of it probably relates to this massive increase in the tech and AI side. There's estimates that the S&P, that 8% of the value up to even 30% of the value is driven by some form of AI
Wow.
component. And so we know that's been running red hot. We know it's fundamentally changing the economy. And you can see blips. We had that pullback, just last week, because there was a report about what they expected AI to have an impact on, kind of mid-level workers. This is the first time that technology is really making an advancement of reducing the workforce, probably since the Industrial Revolution. And so that's a real concern. And how are we going to adapt as an economy to that? So I think that's what we're seeing the most of right now, and watching. On the flip side of that, we're not seeing it in the jobs reports, which is, tends to be a forward-looking forecast. It's kind of that's why I think probably where some of the unsettling comes from.
Are you seeing clients or people you work with wanting to stay away from that tech AI sector? Or are they, I mean, you mentioned the concerns there. Are people kind of saying, hey, I want to stay away from this? Or how's that discussion going?
I think what we're seeing is folks we're revisiting portfolios. I think you're seeing more
Okay.
and more people asking about moving to a more conservative space. And a lot of it is probably driven by that, especially, we're also seeing a lot of folks that we're starting to work with that are coming to us that have portfolios that were, maybe single stock driven, and, sitting on large concentrations of things like NVIDIA and things like that, and trying to figure out how they can reduce their risk profile without,
Yep.
of course, we have the gain problem. that we're realigning a portfolio like that oftentimes results in triggering gain. And that's a concern for them as well. So trying to balance those aspects is a
Yeah.
real challenge.
Yeah. That's kind of a good segue into my next point and the gains that we have. What are we looking at as far as, okay, so clients, I mean, they're selling their businesses, they're selling real estate.
Mhm.
What are we doing, or what's our strategy to kind of mitigate those capital gains through
Yeah.
our wealth practice?
That's a great question. And it really relates down to timing. How much time do we have? In a normal situation, what happens is a client comes and tells us they've sold, they've gotten the proceeds. And historically, the options that we had was to just pour through the portfolio, look for places where there were losses, harvest losses. We all
Yeah.
know, this typical scenario. Lately, that's been difficult because most portfolios don't have a high concentration of losses to go get. So that kind of limits what you can do. Now, the more time we have, whether the sale's earlier in the year, whether the sale has earnout or installment sale situations, or people are planning in advance from the sale, we do have tools. One of our favorite tools as of late is what's called the AQR Flex SMA. And that's a big, long name, but what the AQR Flex program does is we can take a core portfolio and an AQR, which is a fund manager and a very good fund manager with a great reputation, they can put extensions on this. So basically options going long and short. What happens then is, the long and short are very similar positions, like say Coke and Pepsi. One of those is going to win, one of those is going to lose every time because we're doing both sides
Hmm.
of the coin,
Yep.
so to speak. We keep the winner, they sell off the loser, create capital losses, and we can do this kind of over and over and over again through leverage. And we can leverage that, to a small degree or to a large degree, depending on how much generation needs to happen. Again, the longer the runway, the better the results of generating those losses. Now, what we're doing is, we're creating deferred gain, but we're creating a deferred gain in a diversified portfolio versus having a concentrated gain in what you're saying.
Definitely. And that's good. And that's good to point out because we're deferring the game. We're not eliminating tax in any way. We're just kicking the can down
That's
the
right.
road into a future period.
Yeah, it's in the real estate game, it's very similar to doing a 1031 exchange, except in this case, we're utilizing a trading strategy to create capital losses with deferred capital, recognized capital losses with deferred capital gains to offset that. So it does help in the situation though, if you have a concentrated real estate portfolio and you're looking to make that tilt, maybe you're getting closer to retirement or you're saying, my real estate, because of the way prices and real estate values have gone up, has gotten way out of whack. Maybe you feel like you're too overextended. We want to dial that back. It's a great tool to do that in a systemized fashion over time.
What is the approach? So someone comes in, they've got a real estate portfolio, 10, 20 million. It's pretty large. It's very
Mhm.
concentrated in physical assets. What is that? What does that conversation look like as far as diversifying and if they are getting closer to that retirement age?
Yeah, that's a great question. And I'm a big real estate investor myself. I mean, I have 17 doors. It makes up, about half of my net worth. And it's been a struggle sometimes to keep it at half of my net worth.
Yeah.
I have to actually really focus on my investment side because, you know, I'm a believer of balanced portfolios and having balance. So it'd be very easy in real estate, you know, to tilt that direction. It is a very addictive business line.
It is. I agree. I don't have 17 doors, but I dabble in that as well. But it is something that is a little bit
It's
that
great
way.
because you can go see it, right? You
Yeah.
can go see it. You can get your rent check every month. And I'm probably one of the few investment advisors that, has a real fondness for real estate and actually spend a lot of time sometimes coaching our clients in real estate. But it does, it has it, but it does have that addiction where you can tend to over tilt. And again, everybody's different. I know a lot of people who say they're not comfortable with the market. They're comfortable with real estate. They understand the risks. And so they want to over tilt that way. And that's fine. I try to keep it balanced because I want to have that balance of, you know, real estate holdings and liquid assets because, real estate markets do shift too. I was born and raised in California. I was there for the great California real estate crash. I have several investments in Florida, so I know about real estate
Yep,
fluctuation.
yeah, yep, yep,
In our area here, we're very insulated. You
yep.
know, Virginia, Tennessee, West Virginia, North Carolina, our property values have stayed pretty steady, but it is, it still is it's considered a volatile asset. And so having some balance is appropriate. So, we have that conversation. We find out what the client needs is, being a good financial advisor is not applying what your thought process is to everybody. It's finding out who they are as clients and then helping coach them to the best version of what they're trying to achieve.
Yep.
And so, if there are people that are looking to kind of rebalance that real estate, we start looking at, okay, which ones are our best exit points, and then how do we do that in the most tax efficient way? Maybe utilizing AQR. Maybe they've got, you know, either passive losses carrying
Mhm.
over or something like that, depending if they're a real estate professional or not, so that we can utilize those to transition a portfolio. You have all those options. And then we use that to kind of get them in line with where they want to go. Is oftentimes we'll do modeling on that to help them out, to help them see. But, you know, that's just about applying balance. Real estate makes for a great piece of a portfolio. I often described it as kind of the best form of an annuity because you have your annuity payments.
Mhm.
I mean, you're used to this. You get your rent checks,
You get to rent every month, yep.
you get your rent coming in, but you still have your property value at the end. That's where it's kind of different from an annuity where, you run out your annuity and it's gone.
Yep.
But when you have a rental, you have that asset still at the end. You can leverage that asset if you wanted to accelerate cash flow. And you can insure it against, a good portion of risk.
Yeah, yeah. Florida might be a little bit more difficult, but, around
Luckily, I'm
here
in Central, so I can still get insurance.
okay, so you get okay, you can get insurance, so and the premium's not too outrageous, I guess.
It's up there, but it's not as bad as the coastal, that's for sure.
Okay, gotcha. Yeah, I know some folks down there that have properties that are, on the coast and on the Gulf, and they said they just it's almost impossible to get
It
insurance
is.
down there.
It is.
So,
And Florida has some weird rules. And I know the governor's trying to fix those around roofs and they don't have a proration rule on
yeah.
roofs. And so if you could have a 30-year-old roof that gets damaged by a storm and the insurance company has to replace it.
No, wow. Wow.
And
Interesting.
yeah, they need to get that fixed because there's been a lot of fraud around that.
Yeah, I'm sure. I'm sure. Well, especially with some of the more recent hurricanes that have gone on, I'm
That's
sure there's
right.
been a lot of claims that have been submitted
Hmm.
and costing insurance companies a lot of money. So,
That's right.
well, very, very good. Good. I'm glad you pointed out the fact that we don't just try and put folks into a bucket, that we
Hmm.
really talk to them, figure out their goals, what they want to do, and then plan around that when we come up with the strategy.
Yeah, what we've learned there is if you don't do it that way, then we don't have that buy-in. We want to kind of lock arms and go forward with the plan together. So that's why when we build a plan, we build it together. We buy off on it together. We
Yeah.
model it, and it also helps when you think about because every plan's going to hit bumps. We're going to hit a recession. We're going to hit a market
Yeah.
pullback. And when you can go back to the client and say, look, we've modeled this. We've modeled it through the bad times. When we were all cool heads, we knew this was the
Yeah.
way we wanted to go. It just really helps them stay comfortable in rough
Yeah.
times.
That's good to point out. I'm glad that we're working that way with our clients. With you having a tax background, how much does tax strategy drive investments in those decisions and conversations?
A lot, a
Okay.
lot. And I think what happens with, a lot of people when they go to their regular advisor, they get to the tax question and then they get sent,
Yeah. They
you
get
know,
sent to us, or it's an afterthought. They're like, oh, yeah, you can do that. And then they
but
file their tax. Yeah. But yeah, exactly.
And so we're integrated in that, whether it's a person that one of our advisors is working on the tax side, because all of our advisors are still practicing tax professionals, which is one of the things that I always explain to clients is when you boil investing down to its simplest form, you take the money you earn minus the fees you pay, minus the taxes you pay, is what you keep. In its simplest form, that's what it is. So as advisors, we want to be able to manage all three of those lines, what they're making, the fees that they're paying, and the taxes they're paying. And I think by doing that, it creates a value add to the client because we're not leaving a third of that equation to chance.
Yeah, I definitely agree. I'll circle back too. We didn't get to talk, we got into some of that other real estate topics. We were talking about the AQR Flex. Is there a limit on the investment there Is there a minimum threshold you have
There
to?
is. And it depends on that. Remember, we are talking about that leverage ratio. So
Yeah.
depending on how much leverage we're using, they set minimums. So the minimum there is a million for the core fund. And that would allow up to a 45% leverage. So 45% off of that million. If we wanted to do something where we're doing a 200, 100% leverage, or 250, 150% leverage, then we would need to have, that's a $3 million minimum set by AQR. The fund manager. So, and it's because of the amount of work that goes on. These are actively managed portfolios because those all the
Okay.
time.
Makes sense. Makes sense. Is there a certain amount of time you have to stay in that AQR?
You don't, except that, and you can actually move between those categories. So sometimes we will have somebody start in like a highly leveraged model, like a 250, and be 150% leverage. And once we've achieved our capital loss goals, we might dial it back to
Okay.
something like the
Okay.
145. Now, the challenge with exiting it again is we've got a deferred capital gain. The good news on this is not generated to lose money. I want to make that
Yeah. Yeah.
clear.
Yeah. I think that's what a lot of people are probably thinking. They're like, well, why do I want to just create these losses and I'm losing money on my portfolio?
That's
But
right. The targeted return on these, what AQR has been able to achieve, but their benchmark is the S&P 2000.
Mhm.
So it has a decent level of return on it. So it is a portfolio that you can stay in,
Yeah.
and maybe dial it back again if you don't need the capital losses. Like what I would think, dealing with the kind of the typical real estate investor, and a strategy that I've even kicked around for myself to start as we start to think about exiting, is
Yeah.
doing a small AQR, the million, the 45% leverage, and just let those capital losses build, have that, S&P 2000 return in your portfolio, let those losses build, and then they're there. No capital losses carry over. Then we know they're there when we start to exit those real
Yeah.
estate.
So you can use them in the future. That's definitely something good to point out that you could kind of start a little bit early with the anticipation that you're going to be exiting some of those properties and selling them off, and those
Yeah.
gains are coming down the road.
A couple year runway gives us a lot of flexibility.
Yeah. Yeah, it's great to point out. So, yeah, listeners out there, just, as Ryan mentioned, make sure if there's thoughts, if you make sure you're planning on this kind of, we can't do much after the fact. After
That's
you've
right.
sold the property, it's kind of hard to create the losses at that point in times. Obviously for 2025, we're in 2026 now. It's a little late
Hmm.
to make up for those 2025 capital gains you may have generated from the sales. But yeah, good to point that out. I did want to touch on, we kind of mentioned exiting from a retirement planning perspective. How are we approaching that and working with those clients that are getting near that retirement age, whether they have real estate or not?
Hmm.
How are investments in that strategy changing?
Again, it stays really custom, Evan, to what the client
Yeah.
needs. But
Yeah.
one of the things that we do, and it's probably not unique to this, but we do create, with all of our clients, retirement projection. And what this does is this aligns their goals. So we sit down, we spend time understanding their goals, what they want to spend, how they want their retirement to look like. We plug in the assets, and then we can run variations of this model to do
Okay.
testing and stress testing. And it has become such an incredible tool, and our clients really value it because we can say, oh, we've got let's say we want to spend $200,000 a year in retirement. And they said, well, but we'd really like to take our family on vacation every other year to a foreign location. So
Hmm.
we might add in another $25,000, $30,000 every other year. And we can run that into the model and see if it moves the needle on their
Okay.
retirement
Okay.
projection. What we're looking at is, when we do these, is we run them through 2000 market scenarios. And so we're going to have good markets, we're going to have bad markets. So we're looking at what's the probability of them running out of money in their retirement period. For over 85%, we feel really good about it. And if we're below that, we have work to do. And if we're in the 90s, we know we're in really good shape, and we might start to talk about taking risk off the table. We might not need to take as much risk in the portfolio because our chances of success are so high.
Yeah. Once you get to that point.
And,
Yeah,
and so,
that's good to know, and to know that we can kind of pivot quickly, and if there are changes or they want to do something
Mhm,
different, take those vacations or buy a vacation home or
that's right.
nice cars or whatever it is, we can adjust for that.
Yeah, and we can run those models side by side.
Okay,
So they
so
can
comparative, you
literally,
can see it. Yep.
which is a huge tool for them. It really helps them understand, spending behavior in your retirement years is the number one driver of that success. The assets kind of become fixed and we can't add to them very well unless we inherit money. So spending behavior becomes the most important. So understanding how that affects the ability for you to meet your goals is important.
Yeah, very good. That again, I mentioned it before, but it's great that we're working with our clients and figuring out what their goals are to get to that end result that they're wanting to do because everybody's lifestyle and goals are different.
That's
So
right.
that's great. Going back to the very, I'll wrap up with this. Going back to that first part of our conversation, we mentioned concern.
Mhm.
This relates to technology, the AI sector, all that kind of stuff. Do you think that concern is across the board in the market, or is it more of a demographic, kind of the people closer to that retirement age that are more concerned, or is there any differentiation based on the demographics?
Well, yeah, I think, the younger people are, the more time that they have. Now, everybody has their own personal triggers. I meet some very young people who are very risk adverse.
Yeah.
But for the most part, it is the folks that have, that are nearing retirement because they're starting to think about that. They're knowing that their income is going to be reduced because of, retirement or selling their business. We also work with a lot of clients who have had a liquidity event.
Mhm.
So they've sold their business and now they're sitting there realizing that this pot that they have is all that they have. The nice thing about our firm is and our partnership with Focus Partners, who we work with, is we have our own fixed income trading desk. We can build custom fixed income portfolios for those folks that really kind of, increase the stability of a portfolio and the ability to go directly to market and do that, so that we're not selling them things that we already have. Every time we do a buy, we go straight to the market. Whatever we buy it for is what it goes in the portfolio for. And I think the clients have really appreciated the ability for us to build custom ladders because, when you're in a mutual fund, you just can't really always tell what they
Yeah.
have and you're kind of at mercy of how long or short they are. And that gives us the flexibility. When interest rates were rapidly rising, we kept all of our durations really short because we didn't want people to get caught with bonds that were long term
Yep.
in a rising rate environment. Now that we've kind of leveled out, we've been extending those terms out 5 and 6 years, kind of locking in this, upper three, low 4% rates.
Okay. That was actually another item that I didn't have on my list to talk about, but interest rates. I spoke with, I was talking about some financing, just talking about the market in general and interest rates. So that's what you're seeing from your perspective. Interest rates are kind of going down. We're trying to lock in that long
Mhm.
term investment.
Yeah, yeah, we've seen it, slowly 10 yeah, it's kind of stabilized right now,
Yep.
and I think, there's that Federal Reserve chatter this week that's had the market a little uncertain about, that they may likely hold on another cut, could consider a raise,
Yep.
that
Yep.
that kind of information is, you can tell by how volatile the market is about how nervous people are getting.
Definitely. Yeah. There's a lot of talks going on with the Fed right now. So I'm curious what's going to come out in
Yeah.
the near future, both from interest rates and from a bank perspective and financing. I've seen there's been a little bit of shakeup there. They're trying to do some stuff there. So, but no, that's all great information. I appreciate you. A lot of good content today. I mean, the AQR is something I'm sure a lot of folks did not
Mhm.
know about. I heard you talk about it in a meeting just a couple weeks ago. I knew about it, but hearing you articulate it just kind of really helped me understand the value that
Yeah.
can add to clients. So appreciate that, as well as just kind of speaking on our strategy at Brown
Mhm.
Edwards and how we approach clients and meeting their goals. Is there anything else you want to add to the conversation that we maybe didn't touch on today?
Yeah, I think one other thing, and this is a thing that I've used a lot with our real estate clients, and I use it again personally, is one of another really powerful tool when you kind of have a portfolio that's a mix of
Mhm.
investments and real estate is if you have a regular account. So think like we people call it a retail account or a taxable account, but just your
Mhm.
kind of traditional investment portfolio. One thing that I like to do with my folks that are involved in real estate is we actually put what's called a margin on there. And so margin doesn't cost anything to have on there. Think of it, it's very similar to like a line of credit on a house, but it's on your
Okay.
portfolio. Where it's unique and where I use it a lot of times is if I can have a situation, people that are involved in real estate, we've all seen these where somebody wants to close really quickly
Yep.
and We're not sure how we want to pay for the property, whether we do want to leverage it, maybe we want to pay cash. The margin has, typically rates that are below mortgage rates, and there's no closing costs. And so it's based on the value of the portfolio, how much you can borrow and the makeup of the portfolio. But, let's say you have $1 million portfolio and you want to purchase a $350,000 piece of property. You go to you borrow it against that. It's already there. There's no closing. There's no closing costs. And
Wow.
you have an interest rate again it's typically has been below mortgage rates.
Okay.
And then you can figure out how to finance the property later, but you can get it closed, take advantage of that deal. Oftentimes our people leave just leave the margin in place and just let the
Yeah.
portfolio pay it down.
Yeah. That's good to know. Is that something you see used often?
We're seeing it more and more.
Okay.
Yeah, we're seeing it more because I think we're sharing this strategy because, when you're in today's market in real estate, I'm probably not telling anybody that's listening to this podcast anything they don't know, the prices are so elevated, we've got to save every dollar we can. So
Yep.
if we can save help a client save $5,000 or $6,000, $8,000 off closing costs by doing
And if it helps move the needle, move things along a little faster. I mean, what you mentioned, prices are higher, but also, it's cooled off a little bit, but
Yeah.
demand's still high. So people want to close really quickly and move on and get that.
And sometimes you get a better deal if you can, accelerate your closing because if that's what the pressure point is for the seller.
Yeah. Yeah. Especially if you don't have to go through financing and the seller doesn't have to wait for that approval and everything like
Mhm.
that. It just makes everything go smoother and help get the deal.
Yeah, so it's just another tool that, our clients can kind of put in their satchel to give them
Yeah.
a competitive advantage.
Yeah. Well, that's part of this podcast, building up that playbook so you can just add some more notes to the book and bring it out whenever something applies to you and use
Yeah.
that play. So that's great. So, well, I appreciate you coming on today. A lot of good content. I appreciate, especially during tax season, you taking the time to
Oh, absolutely.
jump on here with me. Did want to give you a chance real quick to provide your contact information if people do have follow-up questions, want to talk to you about
Sure.
anything wealth related.
Yeah, so again, my name's Ryan McEntire. I'm with Brown Edwards Wealth Strategies. You can find me on the BE website or on the link to our Brown Edwards Wealth Strategies website. And so happy to talk to anybody. If you want to reach me directly by phone, email is rmcentire@brownedwardswealth.com.
Awesome. So yeah, if you have questions on wealth services, tax, or if you have a question about HYROX, I'm going to learn a little bit more about that.
That's right.
Reach out to Ryan. So anyways, that is a wrap for this episode of the Real Estate Tax Playbook. Appreciate all the listeners tuning in. Please subscribe wherever you get your podcast. If you like what you're hearing, please make sure you share with your friends, colleagues, family. I'd love to have more listeners. We'll be back in the month of May with more content.